All right. How's everybody doing?
Good. How are you?
Pretty good. Thank you. How was everyone's weekend? Anybody get arrested?
Brendan got arrested again.
How come Brendan always gets arrested and you don't?
Because I'm the voice of reason
He's a
for him.
liar.
I'm not a liar.
Well, okay. Let's do this. Brendan, is he getting arrested for anything worthwhile?
Brendan, what are you getting arrested for?
Having too much fun.
Tell the class, dude.
A lot of things, man.
He says he's down bad right now.
Okay. So when we met on Friday, we're going to do the problems associated with Chapter 9. The last two, I wanted you guys to do them at home. So how did you make out with that, Cole?
What'd you say? You broke up a little there.
I said, how did you make out with the homework?
Okay.
Oh, all right. You want to share it with us?
No, I'm a little nervous about sharing it.
All right. In front of everybody, I understand. Anybody else?
For 24, I got a increase of net worth of 2.8 billion.
That looks right to me. How about anybody else got anything different? Let me see. Hang on a sec, all right? Okay, so it's right here, yeah? Chapter 9, number 24 and 25. Before I open it up, how about number 25? Why doesn't somebody tell us what they got for number 25?
I got 500,000.
That's terrific, Nick. Anybody else? So we got number 9 here. I posted on Moodle. Number 24, 100 billion in assets with a duration of 4 years, 90 billion in liabilities with a duration of 6 years. So the assets is 100 billion times was it a drop in interest rates of 2%? The interest rates went up by 2%. So we have a decline in the assets of 8 billion, and a decline in the liabilities of 10.8 billion. So the liabilities fell more than the assets. So the net worth of the bank went up 2.8 billion. So that's exactly right, Nick. Thank you very much. How to fix it would be to shorten the duration on the liabilities or lengthen the duration on the assets. Number 25, we had 30 million in fixed rate in sensitive rate sensitive assets, and 20 million in rate sensitive liabilities. So the gap was 10 million. The interest rate rise is 5 percentage points. So the profits went up by $500,000, as Nick said. Increase in 5% times the gap of 10, the difference between 30 and 20. The way to fix it is to increase the rate sensitive liabilities or decrease the rate sensitive assets. So I would like to encourage all of you to know how to do that. Okay? Okay, let's pick up where we left off on Friday with chapter 10. So chapter 10 was all about financial regulation. Let me get my notes together. We did this. We talked about the preview. We talked about the learning objectives. We talked about having this government safety net. One of the drawbacks of a government safety net like FDIC is moral hazard. The concept that insurance provides increased incentives for a bank to take risk, right? And adverse selection. So the banking industry, in particular Wall Street, is very attractive to risk-loving individuals. Okay? So this concept of too big to fail, government provides a guarantee to large uninsured creditors of the largest financial institutions. Government is afraid of a failure of a big bank. Yeah, we don't want to have any panics in our economy. So this purchase and assumption method is they merge a bank with a willing partner, and that willing partner brings a large infusion of capital. Yeah. But this actually increases moral hazard for the big banks. The bank will behave in a riskier way if they know they're too big to fail. Financial consolidation and this government safety net. So I said there were 2 acts that I wanted you guys to be aware of. And I put some notes on Moodle. I'm going to new share and hang on, see if I can find it. And I can't. on Moodle is chapter 9, chapter 10, my notes. So these are the two acts that I mentioned on Friday. The Regal Neal Interstate Banking and Branching Efficiency Act of 1994 and the Graham Leach Bliley Financial Services Modernization Act of 1999. These were some financial regulation that came into play to try to manage some of these financial institutions, okay? So I wanted to show you that. There were some attempts to restrict financial institution from too much risk taking. So we have bank regulations and capital requirements. And as a matter of fact, I want to also show you on my notes. We have 8 basic types of financial regulation as a result of trying to curb some of the moral hazard on Wall Street. Restrictions on asset holdings. Banks can only hold certain types of assets. They have capital requirements. Prompt corrective action. So the Fed swoops in and says, hey, you guys are out of line and we got to fix it. Chartering and examination. So banks have to go through a rigorous process of becoming a bank and then subject themselves to rigorous examination. They have to have some sort of risk management program in play. They have disclosure requirements. They have some consumer protection requirements, and there are restrictions on competition. So this goes along with this slide, right? So the other thing is minimum leverage ratio. One of the things I have written on my notes here is that I didn't share with you. Capital, total assets must be more than 5%. Basel Accord risk-based capital requirements, they must hold a percentage of risk-based assets as capital. So, and in your textbook, and it's one of the problems at the end of the chapter, but in your textbook, the original Basel Accord, which was in 1988, on page 223 in your textbook, gives you the requirements of percentages that banks were allowed to have. Okay, and when we do that problem in the end of the chapter, we're going to talk more about that. Okay, so we have and then regulatory arbitrage. So this just implies that the definitions of risk are somewhat ambiguous. So what you may consider risky, another bank may say, hey, that's no problem, you know? So this is one of the problems is that people have different interpretations of what poses risk. All right, so capital requirements. The government imposed these capital requirements as another way to minimize moral hazard. So, and that's based on that leverage ratio that I just spoke about in the previous slide here, minimum leverage ratio. Well capitalized, the bank's leverage ratio must be greater than 5%. Increased regulatory restrictions if you are not up at 5%. And then risk-based capital requirements, okay? So I want to show you more from my own. So these are notes that you may refer to as you go through life or this class. 5 levels of classifications of banks based on capitalization. In other words, if we were in class, I would be writing this crap on the board. Since we're not in class and I'm not writing it on the board, I wrote it on a sheet of paper and put it up here for you. So we have levels of classification. A bank is considered well capitalized if they exceed the minimum capital requirements. Those banks are given certain privileges, in other words, like underwriting securities. So level 2 would be they have adequate capital. So they meet the minimum capital requirements, but they are not given any privileges. Then we have undercapitalized. These banks fail to meet minimum requirements, and that will trigger increased investigation by the regulatory agencies. And then we have 4 and 5. These are significantly undercapitalized and critically undercapitalized. These banks would be restricted in their operating activities. They would be required to submit capital restorative plans. They are restricted in asset growth, and they need approval for any new business they want to get into. All right. So we'll come back here. Capital requirements. So Basel Accord, the original Basel Accord in 1988, banking supervision was like 26 pages, okay? So it was fairly lightweight. The Basel II release, which was an attempt to reform the original Basel Accord, was over 500 pages. 500 pages of stuff that banks had to do. It was very, very complicated. Only a dozen or so of the largest US banks are subjected to the Basel II Accord. The rest use some sort of simplified version of Basel II, okay? But we're going to talk about these efforts, these 3 pillars, based on 3 pillars in Basel II. Basel III is in production, we'll say, okay? And we'll come back and talk about that in a minute. So we have pillar 1. Links capital requirements for large internationally active banks more closely to the actual risk, market risk, credit risk, and operational risk. Okay, so there's many now. Basel Pillar 1 shows many more categories of assets with different risk weightings. Yeah, so this vastly expanded on the Basel I Accord. They created these internal risk ratings. So banks use their own model of credit risk. Yeah. So they're transferring some of this responsibility to the banks themselves, which may be not such a smart thing to do. So pillar 2, the supervisory process. So in other words, we just said they're transferring some of the responsibility to the banks themselves, and then they're going to say, well, we're going to watch what you do, you know. So let's let the banks monitor themselves, but then let's put in the procedures that they do to monitor themselves. Okay, so this is fairly convoluted if you ask me, but assessing the quality of risk management in banking institutions and evaluating whether these institutions have adequate procedures in place for capital requirements. Okay, and then pillar 3, improving market discipline through increased disclosure of details about the credit exposure, amount of reserves, officials who are in charge, and this internal rating system. Okay. So, and then I have written down somewhere. So, oh, yeah, Basel III is in production, I said, right? So they're doing a new revision of the Basel II Accord, Basel III. And in your textbook, it says, oh, the release for Basel III is sometime in 2019. And of course, the textbook was printed in 2018, I think, or published in 2018. So a quick Google search told me that Basel III was up for being pushed out on January 1st of 2022. So they've been saying Basel III is coming for years and years, and every few years they push it back a little more. Okay, so that's the story on Basel III. So what are some of the other financial regulatory actions that we do? We have prompt corrective action, right? If the amount of a financial institution capital falls to low levels, serious problems result. So FDIC adopted a prompt corrective action, yeah? One of the biggest components to this prompt corrective action is for the banks to have what we would say more skin in the game, yeah? So if they have more of their own capital at play, they're likely to have a decreased incentive for moral hazard, right? So, I mean, and look at yourself, right? If your buddy wanted to start a business and he asked you for $100, you give him $100, you don't really care. But if he asked you for $1,000, you'd be like, so what are we going to do, right? That's exactly what happens here, yeah? So then we have 5 groups of bank capital. And I just spoke about these on my notes. I just talked about them. Let me share right here. Right here. These are the 5 groups. Okay. So come back here, just so we all know where we are. I know where I am. I think I know what day it is. Okay. So, and then we have chartering and examination. Proposals to open new financial institutions. This is chartering. This chartering presents undesirable people from becoming banks, right? Crooks. We don't want necessarily crooks. We want people of high integrity to run these financial institutions. Yeah. So chartering is screening a proposal to open a new financial institution. Yeah. So, and then we have, they must also file quarterly reports about their assets and liabilities and things like this, right? Examinations, scheduled and unscheduled visits to the bank to be examined by these regulatory agencies, monitor their capital requirement and restriction on assets to prevent moral hazard. So we have these 6 categories that they're being monitored on, right? Capital adequacy, asset quality, yeah, have they given out good loans? Management, right? Do they have some sort of risk management program in play at the bank? Earnings, liquidity, sensitivity to market reports. So we call this a CAMELS rating. And every bank will get a CAMELS rating. So, and here is what I just said for your perusal here. Hang on. CAMELS rating, right? CAMELS. Capital adequacy, asset quality, management, earnings, liquidity, and sensitivity to market risk. All right. So I posted that crap up on Moodle for you guys to just to help us along here. So these are CAMEL ratings that banks have to submit themselves to being examined. Okay. Assessment of risk management. So greater emphasis now is on evaluating the soundness of management process for controlling risk. Trading Manual 1994 for risk management ratings were based on quality of oversight, adequacy of policies and limits, quality of risk measurement, and adequacy of internal controls. And then we have interest rate risk limits. So internal policies, internal management, and either VAR or stress test to look at, what's the downside. Both of these things are going to look at what's the downside. So back in the day, it used to be that they could just take a snapshot. What is the bank's assets and liabilities and where do they stand? Yeah, you take a picture, take a snapshot and say, yeah, they're in pretty good shape. But now it's much more, the market is much more volatile and things move much quicker. So we need real tractable methods of risk management in the banking industry, right? So this is much more of a big deal. The regulatory agencies will go in and say, what do you guys do to control your risk, So there are four elements to their risk management systems that the regulatory agencies look at. Quality of oversight by the board and management. So they want to know who's looking after the people who are making decisions, right? Adequacy of policies and limits for risky activities. Remember last week I talked about Nick Leeson. I mean, who was looking over Nick Leeson's shoulder? That's what they're saying. They want to know that somebody is looking over everybody's shoulder, okay? Quality of risk management systems. So this would be like VAR or stress testing. They want to see the programs that banks have in play, yeah? And lastly, adequacy of internal controls on employees. They want to know that your employee doesn't have like a side job of, on the board of another company, for example. Yeah. They have disclosure requirements required to adhere to standard accounting principles and disclose all kinds of stuff. Yeah. Basel II and the SEC put particular emphasis on disclosure. SOX Acts of 2002, Public Company Oversight Board, and then fair value accounting. So let's look at each of these, right? Requirements to adhere standard accounting principles helps the public evaluate financial institutions and discourages them from taking risks. Basel II, increased disclosure of credit exposure, amount of reserves, the capital requirements, all the stuff that I talked about a couple of slides ago. Yeah, capital requirements. Sarbanes-Oxley SOX of 2002 produce accurate audits enforced by Public Accounting Oversight Board. Yeah. And then mark-to-market assets on the balance sheet must be valued at their fair market price. Right? If you're a railroad company, you can't put that on your balance sheet at the price for the land that you bought 100 years ago. Yeah. Consumer Protection Act of 1969, this is the Truth in Lending Act, must provide info on the cost of borrowing. This is a big deal, if you walk into almost any bank, right, you walk in and there's a little sign by the door, what interest rate they're paying. But they're not required to tell you how often that interest rate is compounded, okay? And that's a big deal. And if we were in another course like corporate finance or investments, we would spend a fair amount of time talking about effective annual interest rate and annual percentage rate. the bank is required to tell you the APR, the annual percentage rate, but they are not required to tell you the compounding period. Okay? And so it could be very misleading if you're not paying attention in your money and banking class in college. Yeah? So let's go back. I know all of you are paying attention, so I'm not going to belabor the point. So, Fair Credit Billing Act of 1974, they must provide information on how they assess financing charges, right? They must not discriminate, so we have equal credit opportunity, must not discriminate on age, race, or gender. So, and then the Community Reinvestment Act, redlining, prevent redlining, and ninja loans. Subprime mortgage crisis illustrated the need for greater consumer protection. So let's talk about some of these, right? Equal Credit Opportunity Act. So they cannot discriminate on age, race, or gender. And this was fairly prevalent, I think, to discriminate, especially on race. And even now, you know, the nation is in turmoil for the problems associated with race that we face today. The Community Reinvestment Act. So, there used to be there's a process called redlining. Anybody familiar with that? Let me just look. Look for something. I want to have a little digression here because it's a little interesting, right? Let's look. Anybody from Long Island? Anybody from Levittown, Long Island? So I read this book. It was like years ago. I was working in Wall Street, so it was years ago. But it was a book of, it might have been an autobiography of Trump's father or a biography of Donald Trump's father, Fred Trump. So Fred Trump was a big real estate developer, right? And he built Levittown, Long Island. And he built the whole town, you know? And, but there was a procedure in place they'd call redlining. So, you know, they'd look at a community map and they'd put a red line down and they'd say no blacks can live on this side of the line, you know, so they wanted to keep the communities only white people, you know, or only some people of a certain socioeconomic background, right? So this is the process of redlining. And I think Levittown, and it's a vague memory and I might be wrong, but if you wanted to know more about it, I think if you looked at Levittown and Fred Trump, you'll learn more about it. So anyway, they got to stop doing that, right? We got to stop doing that. So this was a regulatory government action to stop redlining and discrimination. Yeah. And then ninja loans. What does ninja stand for? Anybody? Prior to 2008, we saw a lot of ninja loans.
There's no like verification process. They just give out loans to whoever wants one.
Yeah, no income, no job. Thank you, Max. So ninja means no income, no job, and you still got a mortgage to buy a house. Yeah, and people were getting these ninja loans prior to 2008 and buying property. And then we had the financial crisis and they couldn't pay back their mortgages and interest rates went way up. And we had all these foreclosures. And you might remember when you were a kid driving around neighborhoods and seeing, for sale, for sale, for sale, for sale, right? Or lots of houses where nobody cut the grass. Yeah, because the people just split, man. It was like the mortgages were underwater. They bought houses that were what was worth way more than what the house was really worth. So they had, a $300,000 mortgage on a $175,000 house. It was cheaper to walk away, So we saw a lot of that because of these ninja loans. That's this whole subprime mortgage crisis. All right. Come on. There we go. Restrict competition. Increased competition means increased moral hazard. Yeah. If the Bank of America is doing it, why can't Citibank? Right? Bank of America is going to make more money if they take that risk. So Citibank can't let them make more money than Citibank. So they got to all get into taking more and more and more risk, right? And the Glass-Steagall Act was repealed, which even created more moral hazard. What else? The branching restrictions prevented non-banks from competing with banks. And you couldn't just put a branch of a bank anywhere, right? They didn't want to have, a branch of Bank of America across the street from a branch of Citibank, because then those two branches would compete. Look at, in your memory, you would have remembered the Wells Fargo crisis, right? A few years ago, where Wells Fargo got done for telling their employees to open up as many accounts as they could. And they were opening up accounts for freaking people's dogs, All right, we almost done. So what else? International financial regulations. So it all became, the economy has become much more global. The textbook used to talk about, the old edition used to talk about regulatory authorities engaged in microprudential supervision, which they focused on individual banks. But it's made the crisis has made it clear that we need to have a macro approach. Yeah, we want to focus on the soundness of the financial institutions in the aggregate, right? Because they're all related. Okay, and then we have in your textbook, I think there's 2 or 3 pages of, this is table 1. So it's a timeline of financial legislation. So we have the Federal Reserve Act, created the Federal Reserve in 1913. These were Glass-Steagall, separating commercial bank from the securities industry, and restricted deposits, interest-bearing deposits, put interest rate ceilings on deposits, and then these were big ones. The Securities Act of 1933 and the Securities and Exchange Act of 1934. So this really changed the way we did securities businesses, a security business in the industry. And then we just moved through a bunch of other things. This was huge, starting the Fed. Glass-Steagall was huge. This was huge. The rest of these not so much. FDIC, of course, is important. And then we had Sarbanes-Oxley and Dodd-Frank. So those were all big, and those are listed in your book. And that's the end of the slides. You'll be delighted to know that that's the end of the slides, I'm sure, because I am. Let's have a look at the problems for a minute or two before we cut loose, okay? Oh, I got a couple of things to talk to you about. Apparently, there is a need for tutors in Finance 301. I don't know why, but a lot of kids, a lot of students seem to be signing up for tutoring help in Finance 301. If anybody's interested in being a tutor for that, you should let me know or let Mark Wilson know. Does anybody know why they need why so many kids need tutors in 301?
The class is really hard.
The teacher's tough.
Very bad teacher.
What are they saying?
Test average was like a 50. The highest grade was a 70.
Why is it so freaking hard?
Teacher's just not
Make it too hard.
James?
The teacher makes it too hard. He doesn't teach.
Oh, yeah. It
Okay,
seems
wait. I feel like the class is okay itself. It's just the homeworks take like hours and hours to do. The homeworks are like unnecessarily
You would
long.
beg our class to get a 60 average on the exam.
Our class average was a 42.
But you must have got a better grade when the grades came out, though, no? Brendan?
What'd you say? You cut
If the class average was 42, he couldn't have failed everybody.
He's
He
not
would
going to
prove
curve
it
it
by
in the second step.
25%.
Sounds like it sucks.
I think he told us the highest grade was a 70.
Yeah, but then people must get A's, no?
I don't think so.
No. Paige, you had that class when? Last year?
Yeah, I took it last semester.
Oh, last semester. But last semester it went all online, no?
Yeah. I don't know. I think it was a little easier having the tests online. But I don't know, the way he didn't do like any like Zoom classes or anything, like he kind of just like recorded lectures and like gave us the PowerPoints, and like I procrastinated a lot, so this is my own fault. But like I think that's probably what made it hard for me, was because I don't know, like if there were like Zoom classes, then I would have like forced myself to go to them instead of like putting all the recorded lectures off.
Yeah. Okay, well, they need tutors for that. For the kids in those classes are looking to get tutored for some reason. So if anybody's interested in helping, let me know, and I'll put your name up. And there was something else, right? Ask you about tutors and I'm working on your case study ones. Okay. So I've been reading them, and everybody did a great job. So the grades, what I'm going to do is just post a grade. And for the most part, the grades are sort of between like 85 and 95. So, you know, if you did a really good job and you probably got an A, a 95. If you were a little skimpy or you made grammar and spelling mistakes or things like that, I backed it down to, you know, a B plus or an A minus. So what you're going to find is I'll just post a grade, a numerical grade. And if you want more clarity on that, I'm happy to talk about it. Just, you know, shoot me an email, say, what the hell, you know, I did good and you gave me an 88 or whatever, right? I'm happy to talk about it, but I don't feel I can go through. It's not like I got them in front of me and I can write down what you did, you know, and hand it back to you. So it's kind of a pain. I've got to open them and read them. And then, so anyway, I should have it done today and you should have grades posted on that. And like I said, I'm happy to talk about anybody's grade. All right. So I see we've got to the end of the class. So why don't we call it quits? When we come back, we'll start on the problems for chapter 10, which I posted on Moodle. And that's it, man. All right, everybody have a good rest of the day.
Thank you too.
Thank you. Have a good rest of your day. Take care.